You might have noticed we've been quiet for the last few weeks. Frankly, the financial landscape has been moving so fast, we didn't want to jump in and just chase headlines. But now, it's time to talk. Before we begin, remember to like this video and subscribe for more economic updates. Moody's just downgraded America's credit rating. But what exactly does that mean? Think about your own credit. When your credit score is high, banks trust you, they're eager to lend you money, and they do so at a good rate. But when your credit score is low, banks don't trust you. They're not eager to lend you money, and when they do, it's at a very high rate. That's exactly what just happened to the United States. For the first time ever, all three major rating agencies say America's not AAA anymore. Here's why that matters. The U.S. government already owes over $36 trillion. And Moody says they don't believe either party has a real plan to cut deficits or rein in spending. The CBO projects U.S. debt to grow another $23.9 trillion in just 10 years. And current proposals like the Big Beautiful Bill that just passed Congress could add an additional $5 trillion in debt over the next 10 years as well. And the consequences? We're seeing them already. Just this week, the U.S. tried to auction off 20-year Treasury bonds, and demand was terrible. Investors didn't want them, so to move the debt, the government had to offer higher yields, over 5% for 30-year bonds, the highest since 2023. And poor Treasury bond auctions spooked the markets. The Dow dropped more than 800 points. The Nasdaq and S&P followed. Bank stocks tumbled, and Wall Street's fear gauge, the VIX, shot up over 11% in a single day. This isn't just market noise. It's the sound of investors asking, can the U.S. really manage all this debt? And it's not just the size of the debt. It's the cost to carry this debt, which is exploding. We are not just borrowing more, we're paying more to borrow. Interest payments on the national debt are already close to $1 trillion per fiscal year. And if rates keep rising, or we keep piling on debt, or both, that number only goes one direction, up. That's why we're seeing a shift away from paper promises like dollars and bonds to hard assets like gold and silver. Central banks have been piling into gold, over 1,000 tons per year for the past 3 years. And Citi thinks that demand will keep going through at least 2026. In fact, both J.P. Morgan and WisdomTree are projecting gold could reach between $4,000 and $5,000 an ounce. Not because of inflation, but because of something deeper, doubt. Gold doesn't depend on political negotiations or promises. It doesn't break down under the weight of debt. It certainly doesn't get downgraded. Gold is always gold.